Same city, same economy, same Federal Reserve setting the same interest rates for everyone. Daniel Marsh is a private equity manager in Charlotte, North Carolina. Last year, he arranged financing for a leveraged buyout. He borrowed $380 million at an effective rate of just under 9%. On a deal structured to generate returns of 20% or more, that borrowing cost is trivial. It practically prints money. Sandra O'Coffer is a school administrator in Charlotte, North Carolina. She has $9,000 in credit card debt across 2 cards. She is paying 22.9% APR. She makes the minimum payment every month. She has been making the minimum payment for 2 years. Her balance has gone up. Both of them live in a country where the Federal Reserve cut interest rates 3 times in 2025. Both of them watched the news coverage. Both of them heard about cheaper money. Only one of them received it. This is not an accident, it is not an oversight, and it is not a malfunction of the system. It is the system. And by the time this video ends, you will understand exactly how it works. Not the simplified version, not the version that makes it sound like a technical glitch, but the actual architecture of how money flows in America and who it flows toward. Because once you see it, you cannot unsee it. Let us start with the mechanism, the part that makes this possible. When people talk about the Federal Reserve cutting interest rates, they imagine something simple, a dial being turned and credit getting cheaper for everyone at once, like a lever connected to the whole economy. That is not what happens. What happens is something more like a waterfall, and you need to understand where the water starts and where it stops to understand why the people at the top of the waterfall get drenched while the people at the bottom are still waiting for a drip. Here's the actual sequence. The Federal Reserve sets what is called the federal funds rate. This is the rate at which commercial banks lend to each other overnight. It's the foundation rate. Every other borrowing rate in the system is built on top of it. When the Fed cuts that rate, it first affects overnight bank lending immediately, that day. The next thing it affects is what is called the prime rate, the benchmark rate at which banks lend to their most creditworthy institutional customers. This also moves quickly, within days. Below that, you have large corporate loans and leveraged buyout financing. These adjust over weeks. As rates fall, the cost of funding a private equity deal drops. The institutions feel this quickly because their loan agreements are tied directly to floating benchmarks. Below that, below the institutional layer, below the corporate layer, below the commercial real estate layer, at the very bottom of the waterfall, you have consumer credit, credit cards, personal loans. And here, the relationship between what the Fed does and what you pay is almost entirely fictional. Here's the proof. In February 2020, the federal funds rate sat at 1.5 to 1.75%. The average credit card rate was 15.09%. By May of that year, the Fed had cut rates all the way to effectively zero, a drop of 150 basis points, to support the economy during the pandemic. The average credit card rate fell by about half a point to 14.52%. 150 basis points of Fed cuts, 50 basis points passed to consumers, the rest stayed with the banks. By Q3 of 2024, the Fed had begun cutting again. It dropped rates by 50 basis points. Credit card rates went up by a full percentage point, the exact inverse of what economic theory would suggest. This is not a lag, this is not a technical delay, this is a deliberate structural asymmetry embedded in how credit card rates are set. Here's the mechanism. Credit cards are priced as prime rate plus a margin. The margin is set by the card issuer. It is not regulated, it is not capped, it is whatever the market will bear. A card might charge prime plus 15%. When prime was 8.5%, the APR was 23.5%. If prime drops to 7.5%, the APR falls to 22.5%. But if the issuer quietly increases the margin to 16%, the rate stays at 23.5%. A 2024 Consumer Financial Protection Bureau report found that credit card rate spreads widened significantly between 2020 and 2024. They cut the base, they raised the margin. Net result for you? Nothing. And the people writing these terms are the same institutions that borrow from the Fed at the base rate. They receive the cheap money at the top of the waterfall. They charge you the expensive money at the bottom. The spread between those two rates, the difference between what they borrow at and what they lend to you at, is profit. Pure, structural, compounding profit. This is not illegal. This is the business model. Now let's talk about Daniel Marsh. Daniel is good at his job. He's not a villain. He's not a cartoon character in a top hat. He's 44 years old, he went to Wharton, he worked his way up, and he runs a mid-market private equity fund in Charlotte, North Carolina that manages about $2 billion in assets. When Daniel wants to buy a company, he doesn't use his own money. He borrows most of it. That's what private equity is. You identify a target, you put up roughly 45 to 50% equity, and you borrow the rest. In 2025, the average all-in yield on new-issue private credit deals, the rate institutional borrowers paid on leveraged buyout financing, was approximately 9.3%, down from 10.5% in 2024. The 3-month secured overnight financing rate, the benchmark these loans float on, averaged 4.35% that year. So Daniel's fund is borrowing somewhere in the range of 9%. Let's be precise and say his most recent deal came in at 9.1%. Now, think about what Daniel does with that borrowed money. He buys a company, he restructures it, he cuts costs, grows revenue, and sells it in 5 to 7 years at a multiple of what he paid. The target return is somewhere between 15 and 25% annually. He borrowed at 9% to make 20%. The spread between his borrowing cost and his return is where his wealth is built. This is what economists call the cost of capital, and the single most powerful variable in building long-term wealth is how cheaply you can access it. If you can borrow at 9 and earn 20, you are building wealth at 11% a year on borrowed money. If you are Sandra, borrowing at 22.9% to cover groceries in a month when your paycheck ran short, you are not building anything. You are running backwards at 22.9% a year. Let us do the actual math, because this is where the story becomes impossible to ignore. Sandra has $9,000 in credit card debt at 22.9% APR. If she makes only the minimum payment, which most people in her position do because the minimum payment is what fits in the budget, her minimum this month is roughly $180. At that rate, it will take her 27 years to pay off that $9,000. She will pay back $17,400 in interest alone on a $9,000 debt. She will pay back nearly $26,000. Now flip the equation. What if Sandra had taken that same $180 per month, the money that is currently flowing to the credit card company, and invested it instead at a modest 8% annual return over those same 27 years? She would have $175,000. The credit card does not just cost her $17,400 in interest, it costs her $175,000 in foregone wealth. That is what financial economists call the opportunity cost, and it is the number no credit card statement ever shows you. Meanwhile, over that same period, Daniel's fund, operating at an 11% net spread between borrowing cost and return on $380 million of leverage, generates wealth at a scale that is simply not comparable. This is not about intelligence. It's not about effort. Sandra works as hard as Daniel, possibly harder. It is about the cost of money. And in America in 2026, the cost of money depends almost entirely on how much money you already have. There is a phrase that has been circulating in financial circles for over a decade. It was used most recently by an economist testifying before Congress, and it goes like this: the wealthy borrow to buy assets that generate more wealth. The poor borrow to survive. In 2026, 29% of Americans say they have used buy now, pay later services to buy groceries, up from 14% just 2 years ago. 54% say they would not be able to make ends meet without these short-term loans. Read that again slowly. More than half of the Americans using short-term consumer credit say they cannot survive without it. They are not using credit to buy assets, they are using credit to eat, at 21% interest. While the Federal Reserve's rate cuts flow efficiently to institutional borrowers, to the leveraged buyout market, to the private credit market, to the commercial real estate market, to every form of borrowing that requires sophisticated legal structures and institutional access, The people at the bottom of the waterfall are paying more, in real terms, than they were 2 years ago. Credit card balances have risen by $482 billion since Q1 2021, a 63% increase in 5 years. Americans' credit card debt is $325 billion higher today than the pre-pandemic record set in 2019, and the interest rate on that debt is nearly double what it was a decade ago. The gap is not closing, it is widening. And that gap, measured over 10, 20, 30 years, is the precise mechanism by which wealth concentrates at the top of the income distribution. Not because of hard work, or intelligence, or innovation. It's about the structural difference in the cost of access to capital. Here's the part nobody in Cower has an incentive to explain clearly. The Federal Reserve is not a consumer protection agency. It is not designed to make your credit card cheaper. Its mandates are price stability and maximum employment. Credit card margins are not in its jurisdiction. The Consumer Financial Protection Bureau has some oversight, but its ability to cap rates has been contested in the courts for years. The Federal Reserve's aggressive rate cuts in late 2024 and early 2025 brought the federal funds rate down to 4.25 to 4.5%. Average credit card APRs remained stubbornly high, hovering near 23.99% in August 2025. This disconnect between central bank policy and consumer borrowing costs underscores a deeper structural issue embedded in the credit card industry. The institutions that receive the cheap money are the same institutions that set the margin on your credit card. They have a fiduciary obligation to their shareholders. Their shareholders benefit from a wide spread. Passing rate cuts to you reduces that spread. The incentive structure is perfectly clear. The outcome is perfectly predictable, and the people writing the rules, the ones who set the regulatory framework, who determine what is and is not permissible in consumer lending, are almost exclusively drawn from the same institutional world that benefits from the current arrangement. Bernanke went to Citadel. Yellen collected millions in speaking fees from Wall Street. This is not a conspiracy. It is a revolving door operating exactly as designed. Sandra O'Coffer does not know Daniel Marsh. They have never met. They probably never will. But every month, when Sandra makes her minimum credit card payment, a portion of that money, after the bank takes its spread, after the capital markets infrastructure takes its fee, after the institutional machinery of consumer credit processes her transaction, finds its way, in some small but real sense, into the system that funds deals like Daniel's. Consumer credit debt is securitized, it is packaged into financial instruments, it is sold to institutional investors, it generates yields. Sandra's 22.9% interest rate is, on the other side of the ledger, someone else's attractive return. This is not poetic, this is accounting. Here is what the data says can actually change this dynamic, not the inspirational version, the mechanical version. The first lever is the spread itself. Research from LendingTree found that 76% of cardholders who called and asked for a lower rate received one. The average reduction was 6 percentage points. Most people never ask. The single most effective consumer action available costs a 5-minute phone call. The second lever is migration out of revolving debt and into installment structures, credit unions, balance transfer products, fixed-rate personal loans, where the margin arithmetic is different and the spread is narrower. The third lever, and this one is structural, not personal, is understanding that the system does not reward passivity. The people who benefit from cheap institutional money stay inside institutions. The people who stay inside consumer credit products stay inside consumer credit margins. Moving between these systems is not always possible, but the direction of that movement, when it is possible, is the single largest financial decision most people will ever make. Sandra, at 38, has started doing something different. She called her credit card company 6 months ago. She asked for a rate reduction. They said no on the first call. She called back 3 weeks later, mentioned she was considering a balance transfer to a credit union. They lowered her rate to 17.9%. She has not paid off her debt, she is not out of the trap, but she is paying $38 less per month in interest, and she has redirected that $38 into a high-yield savings account. It is a small number. It is not Daniel Marsh money. It is not a leveraged buyout. It is the only available lever she has, and she is pulling it. I want to leave you with one number. The average unused credit limit available to American consumers right now, the credit they have been approved for but have not yet borrowed, is $4.23 trillion. $4.23 trillion. The banks have approved it, the terms are set, the margins are built in, the securitization pipelines are ready. They are waiting for you to borrow it at 21%. The question is not whether the system is rigged. The data answers that question. The question is simpler and harder at the same time. Now that you know exactly how the waterfall works, exactly where the water goes and why, what are you going to do about where you are standing?